Hello and welcome to CMC Markets Trading Outlook for the week of November the 30th, 2015. My name is Colin Sadinsky, Chief Market Strategist. There's a ton of different things going on to focus on this week between the Santa Claus rally, Black Friday, a ton of central bank news, a ton of economic data. It looks like this could potentially set up for being a huge week for trading activity. So I'll just kick off and go through a number of the highlights. First of all, it's the first week of December. People are going to be starting to wonder, is there potential for a Santa Claus rally this year? Historically, December is one of the best months of the year for stocks, and that can often carry through to the first week of January as people get to the end of the year and start to look to the new year with optimism. The big question has been, though, could the Fed distort this? And a lot of the news we'll get out this week from North America could likely be viewed through the prism of what does this mean for the Fed in December, their mid-month meeting where they could potentially raise interest rates for the first time this cycle. Well, having gone back and done some work, I did look at December returns, and in the past, a decade, we've had a number of instances where the Fed made a hawkish move or the Fed made a dovish move. When the Fed made a hawkish move, markets were up in December. When the Fed made a dovish move, markets went down in December. Why is that? Recently, New York Fed Governor Dudley explained it and said that a hawkish move by the Fed, a move to tighten, a move to raise interest rates, is a vote of confidence and a sign of confidence for the economy that boosts optimism and speculation on the economy and the outlook for earnings heading into the new year. A dovish move by the Fed would indicate a lack of confidence in the economy, that the economy is weak, and that the outlook for next year isn't very good. So we'll get an idea. But if we are continuing to show signs of heading towards a Fed rate hike, looks like that could be pretty good for the markets. Second thing I wanted to talk about that's likely to kick off this week is a focus on retailing sector again as people digest the Black Friday, Cyber Monday reports and get a feeling for where consumer spending is heading. So I've pulled up this chart here that I just wanted to show briefly here about expectations. And I think a lot's going to be about expectations because we've had a real divergence in expectations this year. And the question will be, does this continue or does this reverse? And so I wanted to highlight Amazon here, up 130% over a year ago. And clearly it's outperformed the field, it's lapped the field, and without a doubt, and they've hired more seasonal workers than other retailers and everything. So expectations for Amazon are absolutely massive. Amazon needs to deliver or its stock could actually be vulnerable. Even if it does put up growth numbers, if it's not as much as the street was hoping for, stock could actually be vulnerable here because just on the basis that it's up so much relative to everything else. On the flip side, expectations towards other companies are actually fairly low. If we look here, this is Walmart's been trending lower through the year. Macy's, Hudson's Bay, are all down on the year so far. Hudson's Bay, of course, owns Saks as an example of a higher end retailer. In the UK, however, the Black Friday phenomenon and retailing in general hasn't been hit as hard. This is Marks and Spencer here. The purple line's up 10% on the year, and UK retail sales has held up a lot better than retail sales in North America. Although it'll be interesting also to see some of the trends we're watching for. One will be this difference between online retailing and traditional retailing. Another one will be between Canada and the United States. Do Canadians flood over the border for the Black Friday sales this year, or is the fact that the loonie's been whacked for 20% in the last year keep Canadians at home? And that'll be an interesting thing to see too as this plays out. So we look for a lot of action in the retailers to start the week. As we move to the middle of the week, the focus changes to central banks. We're in the last couple of weeks before the Fed meeting. The Fed has pretty much put everybody on notice that they're seriously looking at raising rates in December. So if anybody wants to go the last way and get the last kick in this easing cycle before it ends, they've got a couple of weeks left to do it. So this week we've got the big ones, the ECB, and we've got Bank of Canada, Reserve Bank of India, and Bank in Poland as well. So out of that, the ECB is the big one, and they're the one that's most likely to go dovish. There's been a lot of talk from President Draghi for the last little while about potentially bringing in more stimulus for Europe, and that could come a number of ways. The one that's been most widely speculated has been that they could cut the deposit rate deeper into negative territory. We'll also see, what about lending rates? Do they cut those? What about quantitative easing? Do they increase the size of their program? Well, that may not work so much, but could they expand it into other asset classes like municipal bonds or lower tier bonds, even corporate or what have you. But what are they going to do? What measures are they going to take? And will they bring in something new or unconventional and surprise the street? Well, what are we seeing in terms of the markets is the market is certainly expecting some big things out of the ECB, and it's been driving down their currency. So if we take a look at the euro, in the last 6 weeks or so, with and it's starting really here with this big candle down, was when they said they were looking at doing something in December. That's their October meeting, and look at this; it's just been trending lower ever since. So we do have some support here in this 104 to 75 to 105.25 range for the euro. If we break that, then you could test a buck down here. Parity is possible. If we bounce off of that, first resistance here around 108 and then up around 110. And we're also seeing this work its way into European stock markets. So just to mention here, interestingly here, we do have a huge net short position on euro dollar. So people are still expecting them to go fairly stimulative at the next meeting. Now let's take a look at the DAX. And after a pause, the DAX has been absolutely on fire. Look at this. Germany 30 had this nice pause here around this Fibonacci cluster, breaks out, retests, taking off. Huge rally here for it, and we're even actually breaking out of this little downtrend in the RSI here. Next resistance 11,433, and then the top of this candle here is about 11,555, and this level it broke out was 11,215. So pretty solid uptrend underway in the Germany 30. And if we look here, interestingly enough, on position value, we're seeing clients starting to confirm that on position size, we do have clients now slightly bullish, which is encouraging. It suggests there's a lot of interest coming in behind this market. So after another one I wanted to mention was not only will the ECB decision affect its currency, but also the currencies of some of the surrounding countries and areas. People that have their own currencies have had to respond to this. Of course, the last time they went stimulus back at the beginning of the year, we had the S&B remove its peg. We've had comments from a number of central bankers going more dovish. The Bank of England, in particular, recently has been going more dovish. They were expected to raise interest rates in the first half of 2016, and more recent talk out of the Bank of England been a little more dovish. Has the economy in the UK changed? No. What's changed? The ECB's gone more dovish, which has put up an even bigger gap between the two, and they're trying to close this a little bit. And what are we seeing here? We're seeing the pound starting to come back off. But in particular, if we look at euro pound, we'll see that in the last month, the euro has weakened dramatically against the pound. Why has the Bank of England suddenly gone a little less hawkish in their rhetoric? Here's why. Because the pound has been appreciating relative to the euro, and they don't want this to get too far out of hand. So I think this could be one that could be active as well when we get it. And there's been a lot of trading in euro yen, too, on this, and the euro has been driving straight lower against the yen too. It's down here around 130. This support here is around 127.70. So if we break 130, could go lower. We are getting oversold here. If you bounce, first resistance up around 132 and change. So and here we've got clients. Look, it's 90% short. Big jump. This has been really active trading lately on this one, and a lot of interest. So these euro pairs could be very active through the week. The other major central bank meeting this week of note is the Bank of Canada. The big question about the Bank of Canada, will they cut for a third time this year? The Norges Bank, in response to the oil price crash, has cut rates 3 times. Canada's only cut twice. Canada's last meeting, the Bank of Canada held off because it was too close to the federal election. We're now well away from that. The federal government cut their GDP growth forecast for Canada, but we have to wonder how much of that was a politically driven move to blame problems on the preceding government, didn't give them room to come in and try and turn things around. The other thing, Canada in general has been going through a rebalancing, with the oil patch obviously getting crushed, but the lower loonie having a positive impact on other sectors and other regions of the economy. The question has been the back and forth of how does this tug of war play out. We are seeing signs of a transition. The Bank of Canada is probably not under pressure to cut rates. People aren't expecting them to cut rates. If they did cut rates, it would be a big surprise and drive the loonie down. If they don't cut rates, could continue to help the loonie. bottom out. And I'll show CAD US dollar as an example of this first. So what are we seeing? We're actually getting a bit of a reverse head and shoulders bottom. Left shoulder here, head here. This is the 75-cent round number as the shoulder support, and the head level was about 74.25. We start to pick up off of this, and we had a downdraft lately, but if we start to pick up off 75, there's 76, there's about 76.70. I'll show dollar CAD as well. Thing on CAD US, clients are actually getting quite long here on CAD US, so they're getting a little bit more bullish on the loonie. But let's take a look at the more heavily traded dollar CAD. So look at this, we're about 50-50. People are split, not quite sure what to do about dollar CAD while it's been going sideways. Again, we're getting this head and shoulders top forming. In this case, the shoulder resistance is about 133.40. We had a peak up here. This looks like a double top here at 134.30. Upward momentum generally slowing, so we are seeing some top forming in dollar CAD as it goes sideways, and clients are split on which way this could go from here. I also wanted to highlight, while we're talking about CAD, sterling CAD. I talked about how sterling had come off against the United States. It strengthened against the euro, and interestingly enough, so we've got sterling US dollars testing 150. Sterling CAD is testing $2 here. And this is fairly significant as well. Another big round number. We have had a head and shoulders top. Instead of getting a breakdown, we've kind of been drifting lower. But RSI's turned under 50. If this starts to break 2, the next first support is here. That's around 197.10. And this here, this old high and the moving average is about 195.70. So there is some room for a pullback if we can break that $2 level there on sterling CAD. The other big thing that we've got going on in the coming week is the Fed, and speculation on the Fed in two ways. The first of which is the data. There's tons of data. There's manufacturing PMI. There's non-farm payrolls. There's other job reports. Well, Canada jobs comes out at the same time. U.S. and Canada trade come out at the same time. That's all on Friday morning. So Friday morning, potentially a huge day for news. ADP payrolls are on Wednesday. We have a fairly sizable and significant moves going on in the U.S. On top of that, though, we also have a ton of Fed speakers. Fed Chair Yellen speaks several times. Fischer is speaking. Brainerd is speaking. Some of the regional Fed members are speaking as well. And so that's fairly significant because their blackout's going to kick in probably in the week after. And so this is one of the last big chances for the Fed members to get out and signal which way they're leaning as we head into the December meeting. So far, it looks like all systems are go for most of the Fed members for a potential hike in December, and of course when they do get there, they'll probably signal afterwards that future rate hikes will probably be at a fairly slow pace. That's the sense we've been getting from the Fed members. We'll see if anybody changes their tune in any kind of a meaningful way in the coming days. That could drive a lot of trading action as well, not only in obviously in U.S. dollar pairs, but of course one we'll be continuing to keep an eye on is gold. As we keep an eye on gold, gold's had a big sell-off here. It's leveled off in this 1065 to 1085 range. If it falls out of this, could retest the 1,000 round number again. If it breaks up out of this 1100's first resistance, then this 1155 Fibonacci level here. The final thing I just wanted to mention briefly, crude oil prices. Crude oil could also be active again this coming week. It's got its own big support test underway here in and around 40. We see here it dipped under 40. This was a bear trap reversal. What happened was that Saudi Arabia suddenly went, oh, well, after a year of fighting a price war, we think we'll talk to some of the other OPEC and non-OPEC producers about stabilizing the market. 40 seems to be the threshold of pain for the producers. Got under 40 2-3 days in the summer, bang, back up, and look at that move it had. Peaks under 40 here, bang, gets boosted. 40 is pretty well defended by the producing countries. So on that basis, if this $37.50 to $40 could emerge as a fairly substantial support zone for crude oil. On that basis, we're getting a nice saucer bottom in here, but really we're still trading 40 to 42. We break 42, this is 43.80 up in here, this former support level. So there's just a ton of stuff going on. There's big news coming out every single day this week. Lots of potential for trading action.